Hello, everyone, and welcome to The Buck Stops Here. I am Catherine Murray. Well, I'm sure you have seen in the markets we've had a bit of an unleashing of animal spirits since the presidential election, let alone the inauguration. Let's get some perspective in terms of what that means for the markets and your money going forward. And for that, Barry Allen is joining us. He's a veteran in the fixed income world and investing in general, and he's the CEO of DMAT Capital. Barry, great to be with you, and thank you for joining us.
Yeah, it's great to see you again, Catherine.
Thank you. Let's first start. Give me your perspective in terms of really the animal spirits that have been unleashed. Do you go along with it? Do you believe it? Is it sustainable?
No, I think I would say no to all of those, and it's
Hmm.
quite normal for optimism to be high early in the year, especially in an election year with a new government coming in. That's very, very normal. But to see where we're going, we kind of have to look at where we've come from since the election. And since the election, the 10-year Treasury yield is up over 100 basis points. It was up over 120 at one time. Oil prices are up 25%. The US dollar, reflecting the optimism, is now at 50-year highs. Um, and at the same time, China is essentially in recession. Europe is growth is essentially close to zero, and the world is massively focused on US exceptionalism, and the optimism is extremely high. But in the past, those set of circumstances haven't led to positive outcomes. And if you look at the Wall Street analysts, I believe
Mm-hmm.
of 21 Wall Street analysts, the major ones, there are zero that expecting a down year, and almost everybody is up 10 to 20% again, even though the last 2 years uh, have created the stock market's up over 20% each year.
Hmm.
So those set of circumstances historically doesn't lead to me to be optimistic. Um, and you have to look at why did the stock market go up 20% a year for the last 2 years? GDP wasn't particularly exceptional. Earnings grew single digits. The bulk of the returns in the equity markets were multiple expansion. And that happened at the same time as the Fed raised rates from 0 to 5 3/8%, which is an enormous amount. And
Mm-hmm.
the Fed going from 0 to 5 and change didn't really hurt economic growth that much, surprisingly. And it certainly didn't hurt the stock market. And so the simple reason that I can point to as to why those things happened is the US government was running 6.5 to 7% fiscal deficit, which is an enormous amount. They've never run deficits that big a percentage of
Mm-hmm.
GDP except in major recessions like 2008 and 2020. So we had a really strong economy, a record high stock market, everything good, rising interest rates, but the government still ran a massive fiscal deficit. And I think
Mm-hmm.
that's going to be the key going forward as to what happens to the US dollar and what happens to the fiscal deficit. Those are the two things that I'm keying on most to see as the year unfolds, to see whether the optimism is going to play out in that direction or not.
Mm-hmm. A lot to unpack there. And just to kind of break it down a little bit, it seems as though you're saying that when you look at the growth of the stock market or the growth of the economy, it was really induced because of the continuation of fiscal spending, of deficit creation. And I think you've been saying for years that at some point, that's not going to be sustainable. So we got to see what the U.S. government is going to do about it this year, let alone other governments in the world. We're going to take a quick break. We'll be right back.